What's your rating on D.R. Horton? What's your price target for the nation's home builder? What are you expecting from this report?
Sure, thank you very much. Well, we rate the shares market perform and have a $142 price target. Although we do rate the shares market perform on valuation, we would be inclined to be positive going into earnings. And the key is that low inventory trumps rates in today's environment. That's our main takeaway. We think that the home builders have become the only game in town in the housing market, and this is because inventories of existing homes are at record lows. In fact, 50% of a normalized rate. So home builders do have tools in their incentive toolkit via mortgage buydowns and other incentives that can help mitigate affordability challenges.
Got it. So your price target indicates about a 25% upside. You're just about in line with the street with that price target, just for some perspective there. You just mentioned mortgage rates. I want to talk to you about them. So we have definitely seen them pull back. We saw them hit about 8%, right now at about 7.5%. How does that impact your view, not only on D.R. Horton, but the entire home builder sector?
Well, I think that the backdrop is that existing home inventory, which is 90% of the housing market, will remain low. And as I mentioned, it's at around 1 million units, less than 1% of total households. So the home builders, through their reverse engineering of a more affordable product, as well as their incentives, can help mitigate this supply overhang and also use mortgage buydowns to create an affordable product. Now, I do think there will be some pressure from rates, but they are better positioned than the overall housing market to contend with this headwind. What we're looking for is, did the demand hold up post-September 30th, driven by the low inventory? And number two, are these mortgage buydowns really crimping affordability? If they can talk to a managed approach to incentives, we think that it'll be enough for the shares to respond positively.
All right, so again, that D.R. Horton report coming up in just about an hour. I want to talk to you about the broader home builder space, looking at the ITB. That's the iShares Home Construction ETF, coming off of its best week since May of 2020. Of course, that was just when the pandemic was just kicking off. D.R. Horton, the top holding there, about 15% of that ETF. How much of that spike in that ETF is due to people thinking that the Fed is done hiking rates? The things that we're hearing from Neil Kashkari, does that change that narrative at all?
Yeah, I think the outlook for long treasuries is really the reason for the recent performance. You've seen the 10-year decline from about 5% to about 4.6%. And that's a key driver of the long mortgage rate. In addition, the uncertainty about the rate outlook has weighed on mortgage spreads. And so we think mortgage spreads are imputing an additional discount related to that uncertainty. And so to the extent that the Fed is finished hiking rates and long treasuries remain settled, there should be some potential for the absolute mortgage rate to decline. Finally, I would also mention that ARM production, which is adjustable rate mortgages, are at record lows and could potentially be poised to increase, thereby helping mitigate this headwind.
Well, Jade, I definitely wasn't expecting you to say that. So you think ARMs are going to make a comeback because ARMs generally have a lower rate?
Well, I wouldn't overemphasize that point, but there is potential for an increase there.